am very happy that Roger Whitney was able to come back just a few days after his last interview. Roger Whitney is the retirement answer man. And Roger, I got to tell you, we were on the show a few days ago, and believe it or not, you said something a little bit more controversial than people often do on this show.
Oh, boy.
And this is what you said. You said, don't worry about what you think is going to happen in the market. You have to just have a system that you invest in. Well, of course, I'm a big believer in financial planning and asset allocation, but I speak to clients like you who are entering retirement years or they are retired, and they are afraid of a major crisis during the retirement that will completely derail them, and then they're going to have to, move in with the kids. So what happens how do you prepare for the real possibility of a major crisis that could absolutely ruin someone's retirement?
Well, I think you do a couple things. I think one is you don't do duct tape financial planning, which there's a lot of that out there. You do serious financial planning to test against a lot of these risks. And you do bring up a good point. And some really good studies show that first 5 to 8 years in retirement is sort of the hot zone. If you have big market drawdowns early in retirement because of the way numbers work when you're withdrawing money and everything else, it can really mess up the whole plan. So you really got to be serious. And there's some good argument to be more conservative on the front end of retirement and slowly get more aggressive because your time frame compresses. Now, I don't particularly do that in my practice, but what I would say is outside of managing the investment assets, you really want to manage your balance sheet to make sure you have lots of liquidity on your balance sheet, which will act as a shock absorber and allow you to keep on cruising on your income or your lifestyle when and if we have some of these kind of events we're talking about.
All right, euphemism, man. Say that in plain English.
Have a lot of cash reserves.
That's it. That's it. That is the emergency fund. Enough of this fancy schmancy talk. I think it's really important. And the problem today, or what do you tell people when they say, yeah, listen, what, you want me to keep $50,000 in cash or $100,000? Are you crazy? The banks pay me 0% and I'm losing against inflation. How do you answer that one?
Well, I think for clients, we usually have them keep 2 years of expected outflows in a bank. So it could be a lot more than $50,000 depending on who you are. Where your return on investment comes from when you're in cash is going to be in a couple areas because life will happen to you. Where your return on assets are going to come is if an unexpected event happens in your life and you need money, if you overspend plan, which many people do, or if you have a big drawdown in the markets, your ROI or return on investment is going to come from not having to blow up your lifestyle or sell at bad prices. And a lot of it too, Doug, and I'd be interested in your view on this, when people say to get more conservative in their asset allocation as they age, which means buying more bonds, right?
Yeah.
Well, buying more bonds in a low interest rate environment means you're getting almost no yield and all the investment risk. So I'm going to use another fancy term on you. So by having lots of cash reserves, you want to make it a little bit like a barbell. If you're, and Doug, I know you go to the gym all the time. The barbells that you do curls in, so your guns look big for the beach. You have a lot of liquidity on one end of it. You have very little in the middle, like the handle. And then on the other end, you have your long-term risk assets. So I think in a lower interest rate environment, having a lot of liquidity really doesn't hurt you as much as normal times.
Yeah, one of the ways that I explain it to people is that whenever you want something, you have to pay for it. And if you want to have liquidity, which means access to your money when you need it, no matter what's going on with the market, you have to pay for it. And the way that you pay for it is by, unfortunately, not getting any interest on the money. And it drives me crazy. I do it myself. I do it also not only for myself, I do it for my business. I can't be in a situation where I have to pay my staff and all of a sudden, things didn't work out so well, guys. I'm sorry I can't pay you. I once heard that Bill Gates, when he was running Microsoft, kept 1 year of running expenses for the company. I don't know if this is true or not, but it's just a good point. He kept a year worth of running expenses in the bank so that he would never be in a situation where he had to take a bad deal or do something questionable for the company. He wanted to be able to make payroll every month and pay all the bills. And I think that's the same thing in real life, especially when you're retired. But what about the question, and does your barbell strategy also include the idea of having growth in the portfolio as well, even for retired people?
Definitely. I think definitely. So if you take a 60-year-old today Right now, statistically, they have a 50-50 chance of living past age 90.
Wow.
Think about that. That's huge.
That is huge.
And that's 50-50. So if you skew social, economic, and for other factors, a good swath of people are going to live a lot longer. So when you're at age 60, you're not investing for a 5 or 10 year time frame. You do have that long-term time frame, that 30-year time frame that you still have to take care of, and your main enemy there is inflation. Now, that doesn't mean you just load up on growth stocks. You want to have a portion of your portfolio as an inflation hedge to participate in the growth of the world economy. And you also want to have equities that are throwing off income, because that acts like the wind at your back, right? It helps you along and helps you through market downturns. So it's a little more nuanced than do I have growth or not.
And do you feel that people who maybe never owned or managed stock portfolios on their own, when they hit retirement, that's a good time to start?
What's interesting is what I find as a retirement answer man and talking to people and working with clients is they're so used to wealth accumulation, right? They've been accumulating wealth at whatever levels through their 401ks, retirement accounts, investment accounts, and everything else. A lot of people have gotten fairly comfortable with risk, so they do one of two things. Either they just stay that way, not really realizing that maybe they should dial it down because it's less about accumulation and more about the utility or the usefulness of your wealth. So either they stay too growthy or they get way too conservative. Mm-hmm. And I think the key when you're thinking about risk, especially when you're entering retirement, is to think about it not as maximizing potential returns or limiting risk, but doing the hard work to analyze what's the minimum effective dose of risk I need to position me to achieve the lifestyle goals that I'm outlining. And that's a very different way of thinking about it.
I think the hard part also is that people don't really get this term risk. I get this a lot of times. People say, a client will come in and I'll say, I have an account with some other firm. I've got $1 million. It's a very conservative account. And I look at it and it's got of the $1 million, 900,000 is in the stocks or stock mutual funds. And I point this out to them and I say, this is actually an ultra aggressive portfolio. And they say, no, it's not. I've made money over the past few years. And then I said, those are two different things. Making money is great. I would hope you make money sometimes if you have a high risk portfolio, but that doesn't mean that it was a low risk portfolio. It just means that the risk that you took, in fact, paid off during that period, but it's still high risk. And interestingly, I think people who may have been in the market for the past few years don't really appreciate what risk means because maybe they've already begun to forget what it was like when the market dropped 50%. Was it only 8 short years ago?
Yeah. And being a good steward of your family's wealth when you're in retirement, because we're not trying to accumulate, we're actually trying to use our wealth to give us something we care about more, which is lifestyle and not running out of money and everything else. And that is a very different equation. I'll give you an analogy. When you're young and growing up, you can go to parties and you can drink and you always feel okay the next day and everything else, right? When you're in retirement, from a risk standpoint, you want to be like the designated driver. You want to, when the party's going on, you are more concerned about getting home and being able to wake up and take care of your family and do things that you want to do the next day. Mm-hmm. But when the party's going on, even though you're being prudent, you feel like a stick in the mud, right?
I hear.
But towards the end of the night, when everybody's really having fun, you even get a little bit more jealous, but then you start to see how silly it is. But you're always the one that gets home. You're always the one that wakes up, and you're always the one that's able to love on your family the next day. That it's sort of like being Rodney Dangerfield. You get no respect on either end. You don't get any of the fun, except you get to live the life that you want without blowing it up.
I hear. Well, Roger Whitney, tell me something. If people wanted to party with the retirement answer man, but still have a designated driver to take them safely home to retirement, how can they keep track of you?
Well, come listen to the Retirement Answer Man show. Right now, we are doing a live case study with a fellow listener. So I'm doing a retirement plan for the listener. We've changed their names, and you get to listen in as we go through each step of the process, which is a lot of fun. This is the third time we've done it, and it's the number one thing asked for on the show.
No kidding. I love that idea. I'm going to listen to that, and maybe if you don't mind, we'll adopt that here on the Goldstein on Gelt show. All listeners, you can start writing in your stories and see if maybe we'll pick those up and follow the example of the retirement answer man right here in Israel on the Goldstein on Gelt show. Roger Whitney, thanks so much for joining again.
Thank you, buddy. Be well.
You've been listening to the Goldstein on Gelt Show with money maven Doug Goldstein. Doug's weekly radio show is heard around the world, but if you miss it, you can download the podcast at www.goldsteinongelt.com. The Goldstein on Gelt Show gives you up-to-date financial ideas so you can get on the path to financial freedom. If you'd like your questions answered on the air or off, send Doug an email to doug@profile-financial.com. It's your money for your future, so join Doug every week to build your wealth on the Goldstein on Gelt Show.